name is Duncan Gafney. I'm here on behalf of Eulogie. We've been doing financial education and awareness seminars now for circa 16 years. But one thing that became very apparent over the last few years in particular, that there were certain areas that were of significant concern to higher earners, particularly within the NHS, that weren't covered within our normal seminars, and as such we created a special seminar to cover off those particular areas. Just as a quick reminder, as my colleague Neil has covered in previous webinars, Eulogie is part of the Apollo MAM group. However, it's important to remember that we are all about financial awareness, education and information. I am not a financial advisor. I am not licensed to give advice. I am not allowed to give advice, although I do train financial advisors on technical pensions and taxation. Usual caveat, just to turn around and say that yes, clearly everything is, if you like, factually based and as up to date as is possible, but I would just draw everybody's attention to the bottom point there, which is that within the webinar and any seminars that we run, we do use sometimes stereotypical scenarios just simply to help illustrate points. But that is the point. It is there to help illustrate the point, and it shouldn't be observed as any form of non-inclusion. Okay. Again, as Neil has previously mentioned in previous webinars, it's a very natural human thing to have a tendency to follow the herd a little bit, to do things on the basis of you've heard that they're a good thing from a friend, a family member, or a colleague. I highlight it in this particular seminar just simply because the fact that the more you earn and the more assets that you have, the more important it becomes for you to take financial decisions on is individually right for you, and not what just taking that on the basis of what you've heard might be good from a friend, a family member, or a colleague. So what is the purpose of the webinar? This particular webinar covers two areas of main contention that have been in the news and in the press a lot over the last 2 or 3 years. The first one, which is the pensions annual allowance, that's been creating the majority of the headlines. We've heard about people being unwilling or worried about doing additional shifts, earning additional money in case it creates major tax problems for them. And the second one is around the pensions lifetime allowance, which, although that tends to generate less queries and less questions than the annual allowance, it is definitely probably number 2 on the list of the questions that we tend to get. And lastly, we just want to explain a little bit about how these allowances interact with both the NHS pension scheme and other taxation in general. Okay, so as a little bit of a reminder, we'll just go through a little bit of NHS pensions because it's important for you to understand how NHS pensions are calculated and how your benefits are worked out. And it's also very important for you to understand that the things that we're talking about today, both the annual allowance and the lifetime allowance, apply to the total of your NHS pensions, plus any other pensions that you might have. So if you've got membership of both the 1995 and the 2015 scheme or any other combination, you need to understand that you need to be able to work out what happens when you put them together. So just as a little bit of a reminder, your pension benefits are worked out primarily on the basis of 3 main factors. The first of those is what is your pensionable pay? And it's important to remember that this is always based on a full-time equivalency. So it's always based on a 37.5-hour week, regardless of whether you are part-time or full-time. If you are part-time, then any proratering is done on the basis of pensionable service rather than on pensionable pay. It's just simply they have to do it this way to make sure that they can take account fairly of people that go part-time, full-time, full-time, part-time, and so on and so forth. And the last area that, if you like, it's calculated on is what is called the accrual rate. Now, this is always 1 divided by another number, and generally speaking, the smaller that number from an accrual rate perspective, the better. So for the 1995 scheme, it's a 1/80th plus cash scheme. The 2008 scheme is a 1/60th scheme, and the 2015 scheme is a 1/54th. So actually, from an accrual rate perspective of all those schemes, the 2015 scheme is actually the best. So what are these two pension allowances? Well, fundamentally, it means that pensions are limited in one of two ways. You've got the annual allowance, which is the amount of money that you are allowed to pay into a pension scheme each year and attract tax relief. And then you've got the lifetime allowance, which is the maximum value of pension that you are allowed to build up during your lifetime. And if you exceed either of these allowances, then tax charges will apply. So moving on to the annual allowance. The annual allowance, as previously mentioned, is the amount that you can contribute to a pension in a tax year and receive tax relief. Normally, it's £40,000, but this may be reduced by tapering. And tapering is something I will explain in a little bit more detail in a few slides' time. If you exceed the annual allowance in any one year, then you may be able to do what's called carry forward unused relief from up to the 3 preceding years to allow you to prevent a charge from occurring. Now, what carry forward is, it simply means that if, say, for example, in a previous year, you'd contributed £20,000 into a pension and the normal allowance that you were allowed was £40,000, there would be another £20,000 that you hadn't used. And you are allowed to carry that forward and use up that unused relief. If you do exceed the annual allowance plus any carry forward, then you will have a tax charge to pay. And likewise, the tax charge can be paid either directly via self-assessment or potentially using scheme pays. But it's important to remember that which one of those is best for you can only be calculated on an individual basis, and that, if you like, you shouldn't really follow a particular guide in there. It has to be worked out on an individual basis as to which is the most advantageous. And another key point there to remember is that for defined benefit pensions, like all three main versions of the NHS pension scheme, the deduction that you see from your salary that is listed as a pension contribution and the percentage of your earnings that NHS pensions pay into the scheme is almost, not quite, but almost irrelevant. The contribution itself is calculated on a basis of a multiple of how much your pension has increased in the year, and it has to be and can only be calculated by NHS pensions. So in order to help you try and understand it a little bit more, what we've done is we've created a few working examples just to help illustrate some of the points and hopefully make these things a little bit more understandable. So in example 1, Surinder is 44 years old and started working for the NHS on the 6th of April 2019. She's in a senior management role and her salary is £160,000 a year, and she is an active member of the 2015 scheme. So what does Surinder need to be aware of? Well, firstly, that she needs to understand that because her pensionable salary is over £135,000 and she is an active member of the 2015 scheme, this means that she is highly likely that she will potentially breach the annual allowance each and every year moving forward. She also needs to understand that because her taxable income for the 1920 tax year was more than £110,000, she will have a tapered annual allowance for the 1920 tax year. And she needs to remember that if she does end up suffering an annual allowance tax charge, she has a choice of how to pay it, either paying it directly or using scheme pays. So moving on. In example 2, John is a consultant and has been working for the NHS for 27 years. He has extensive membership in the 1995 scheme, but he is now an active member of the 2015 scheme. He's just had his triennial pay increase up to £127,800 from April 2020. But he also received £9,000 per annum of rental income, and he's been very nervous about the things that he's been hearing about annual allowance tax charges and cliff edges and things like that. So what does he need to understand and take into account? Firstly, that his earnings from the NHS alone don't cause him to have any annual allowance tapering issues. However, when he adds the rental income that he's got from his property into the equation, this may cause him tapering issues, at least up until the 6th of April 2020. His active membership of the 2015 scheme, again on its own, is not likely to cause him any annual allowance issues on its own. However, because he also has significant membership of the 1995 scheme, and the final salary linked to the 1995 and the 2008 scheme is maintained, there is a significant chance that when he gets a pay rise, this will cause annual allowance usage for the 1995 scheme, so that then when that is added together with the annual allowance usage that he has for the 2015 scheme, these may cause him to go over the annual allowance in some years. And again, if he does have annual allowance tax charges to pay, how should he pay them? And likewise, if he does have any annual allowance charges from previous years, then he needs to understand and speak to somebody about those as well. Example 3, Julia has been working for the NHS in nursing since she started 32 years ago, but last year she was promoted into a managerial role, which included a £10,000 pay rise up to £65,000 per annum. So she wouldn't normally be sitting in one of these higher earner seminars, but she had heard that this can cause her problems to do with pension taxation, and she wanted to know more. And she is an active member of the 1995 scheme. So again, what does Julia need to be aware of? Firstly, that because she has long service and she's just received a £10,000 pay rise, this is highly likely to be going to cause a very large amount of usage of the annual allowance. However, she needs to also be aware that she's unaffected by tapering of the annual allowance because her earnings are nowhere near high enough to cause that to be an issue. But likewise, she also needs to understand that because, if you like, that she was a relatively lower level of earnings in previous years, she should have a significant amount available carry forward to hopefully mop up at least some of that excess contribution that is likely to occur. Another key point to remember for her is that dependent on when in the year that she got the pay rise, this may cause these large amounts of annual allowance usage to be spread over more than 1 year. And the reason for this is because of the way that final salary definition works in the 1995 scheme. For anybody that sat in the previous webinars, you hopefully will maybe remember that it's the best of the last 3 years before you retire. So if, say, for example, you get a pay rise in April, which is the start of the pension and the tax year, by the time you get to the end of that year, that pay rise will have been in effect for the whole year. And as such, when your pension benefits are worked out and the amount of annual allowance that you've used is worked out, it's based on an entire year at that higher level earnings. If, however, say, for example, that pay rise occurred in October, halfway through the year, and the pay rise will only half take effect for the next year, but then the following year, the remaining half of that pay rise will kick in. So it may mean that that annual allowance usage is spread over more than 1 year. So as I previously mentioned, annual allowance tapering. What is annual allowance tapering? Now, basically, it's a thing that occurs when 2 specific criteria are met. Both of these criteria have to be met. So if you only meet one of these criteria, it does not apply. First of these is that you have to exceed what's called the threshold income. Now, previously, for previous tax years up to the 1920 tax year, this was £110,000, but in the budget of March of this year, it was increased for the current tax year up to £200,000. The second thing is if you exceed what's called the adjusted income. And again, previously that was £150,000, and that's now gone up to £240,000. But what are threshold and adjusted income? Threshold income is quite simply put your total taxable income that you earn from the NHS, but then you need to add on any other forms of taxable income that you might have, whether that be interest, whether that be dividends, rental income, pension income. Anything that is taxable as income has to be added to that. Then your adjusted income is just quite simply put your threshold income plus your deemed pension contributions, which we mentioned previously. Just a little tip, you will notice that if you have a look at your end of year P60, your NHS taxable income is listed on your P60. But when tapering does occur, your annual allowance is reduced by £1 for every £2 that you are over the adjusted income. So if, say, for example, you were £1,000 over the adjusted income threshold, then your annual allowance would be reduced by £500. So it would drop from 40,000 down to 39,500. Now, there are a few additional key points that you need to be aware of in relation to annual allowance tapering, and these are fundamentally that you will only be notified automatically by NHS Pensions or any other pension provider that you have if you have exceeded the standard £40,000 annual allowance. So if you are tapered and you have exceeded that tapered annual allowance, but you haven't exceeded the standard one, you will not automatically get notified. Secondly, if your threshold income exceeds the limit, then what you will need to do is each year you will need to make sure that you request an annual allowance usage statement from NHS Pensions. And generally speaking, you probably want to request that round about in August. Another key point that confuses a lot of people is that even if you leave active membership of the pension scheme, that does not necessarily prevent annual allowance tax charges from occurring. And the reason for that is, as I previously alluded to, is because the final salary link on both the 1995 and the 2008 scheme is maintained for as long as you continue to work for the NHS or until the point you retire. The only way to break that link is to actually stop working for the NHS. And lastly, anybody who is affected by tapering can only calculate what your annual allowance was for a particular year after that tax year has ended. So you can't work it out during the year and then take preventative measures. You can only calculate it afterwards. So this leaves me on to number one on my to-do list for today. There are 3 to-dos that I want you to take away from today. And the first one of those is take a look at your P60 and have a look and see what is your taxable income listed on that. Then have a look, what other taxable income do you have? And if you add those things together, does that number exceed £110,000? If it does, then you need to make sure that you request an annual allowance or pension savings statement from NHS Pensions each year. As some people may be aware, last year NHS England issued a promise in response to all of the problems that were occurring around annual allowance tax charges. And basically that promise was that they would cover the annual allowance tax charges that occur for any clinical staff within the 1920 tax year. However, what you may or may not be aware of is that there are certain conditions that apply to that promise. And it's critically important that anybody that is potentially affected understand the implications of those conditions and what you must do in order to make sure that you benefit from that promise. The first of these is that you must calculate what, if any, annual allowance tax charge you have due. However, under normal circumstances, you wouldn't normally know what annual allowance tax charge you might have due until around about October 2020. Because it takes NHS Pensions quite a while to work out what your usage is. Again, anybody that, if you like, breaches the standard annual allowance gets notified automatically, but anybody that thinks they might be tapered, so going back to my previous to-do, needs to make sure they get the request into NHS Pensions so that they can make sure that it gets calculated. Currently, or normally there is a 3-month turnaround time to produce an annual allowance usage statement that's declared by NHS Pensions. But I know from a conversation I had with them only this morning that because of coronavirus and because of, if you like, only essential functions being performed for a certain period of time, they've got a significant backlog on these things. And currently they're estimating it may take anything up to 4 to 5 months to issue such a statement. Then this moves on to the second thing that you must do is once you've worked out what your annual allowance tax charge is, what you need to do is make sure that you declare that via your income tax self-assessment, and the deadline for that is 31st of January 2021. Then once you've done that, you need to complete what's called a scheme pays election to pay the charge using scheme pays, because that is one of the conditions of the charge being covered by NHS England, and that has to be done by the 31st of July next year. You may also have heard that as I previously sort of alluded to, that there were changes in the budget for this year in an effort to reduce the impact of annual allowance tapering and cliff edge taxation on NHS staff. And fundamentally, the government's changed three things, which is firstly, as we've already mentioned, they've increased both the threshold and the adjusted income. And the third thing is that they've reduced the maximum, or they've increased the maximum amount that the annual allowance can be tapered to. Previously, it could be only reduced to a minimum amount of £10,000, so you knew you would always have £10,000 of annual allowance. However, now for the 2021 or the 2020-21 tax year onwards, it can now be potentially tapered down to as low as £4,000 if your earnings are high enough. So what do you need to think about and remember in relation to these changes? You need to firstly remember that the next set of annual allowance declarations to be made are for the 1920 tax year and therefore fall under the old set of rules. However, for a lot of people, these will be covered by NHS England's promise. Secondly, that most high earners will still potentially suffer annual allowance tax charges, but because of the changes to tapering, on average, they will usually tend to be smaller. And moving forward, only those with a taxable income over £200,000 will potentially suffer annual allowance tapering. In an effort to help people hopefully understand whether this is something that they may or may not need to worry about, we've created a list of people that are quite likely to breach the annual allowance, maybe not necessarily every year, but certainly sometimes. But please do remember that this is not an exhaustive list, and there will be people outside of this scenarios that will potentially have a problem. Firstly, as already mentioned, anybody with pensionable earnings over £135,000 who is an active member of the 2015 scheme will potentially exceed the annual allowance each and every year moving forward. Anybody that is a higher earner, so sort of circa 90,000 plus, who receives an above inflation pay rise and who has significant membership of the 1995 or the 2008 scheme may also suffer an annual allowance tax charge. Mental health officers with over 20 years service on higher levels of earnings, so sort of around about 50,000 plus, but mostly pretty much any mental health officer that's got over 20 years service needs to be aware that if they do get a notification from NHS Pensions they've exceeded the annual allowance, they need to make sure that whether they do actually have an issue. Anyone purchasing added years pension or additional pension, which is one of the options for increasing your pension, and anybody that receives a significant pay rise that's got longer service in the 1995 or 2008 schemes, even if you're not a higher earner. It's not about so much what your earnings are, it's about the size of the pay rise and how long your service is. And the longer your service is and the bigger the pay rise, the more likely you are to have an issue. And likewise, anybody that is taking ill health early retirement with an enhancement to service, it's very, very likely that they will potentially have an issue with the annual allowance. And likewise, consultants or medical staff who are subject to pay reviews once every X number of years. I think for most consultants, it's usually 3 years. So they get no pay rise for 3 years and then they get a bigger one. In the year when they get that bigger one that occurs, then that's more likely to trigger annual allowance usage over the normal 40,000, whilst in the other years it's likely to be less likely to use it. So top tip number 2, or to-do number 2, would be, have you ever received a letter from NHS Pensions talking about the annual allowance and saying that you might have exceeded it? Usually it will be a 3-page letter and it will have a variety of tables on it. If you have received one of those, did you deal with it? Have you received one of those? And if you receive one of those in the future, please do make sure you don't do what some clients that we've come across have dealt with and file it in a drawer and forget about it. It's not something that's going to go away. It's like chewing gum stuck to the sole of your shoe. If you keep treading it into the house, it's just going to make it worse. It is something that you need to deal with. You need to work out, have you breached the annual allowance? And if so, by how much? So make sure that if you do ever get one of these letters, that you please do not ignore it. So moving on to the lifetime allowance. The lifetime allowance was first introduced in 2006, and when it was introduced in 2006 all the way through to about 2010, when it was going up and peaked at 1.8 million, it wasn't really causing a problem for terribly many people. There were only a very few people that were affected by it. But government policy over the last 10 years has reduced it down from 1.8 million. It did go down as low as 1 million, and it's currently sitting at just over 1,070,000. But then we also add in the fact that everybody's pay has been going up over this period and their pension benefits have been going up over this period. And it just means that an awful lot more people will be potentially affected by it now than they would have been affected by it when it was first introduced. So what is the lifetime allowance and how do you assess your pension against it? Well, firstly, you are only assessed against the lifetime allowance when you actually take pension benefits. So if you're just continuing to accrue pension benefits and you're not touching them, you will not be assessed against the lifetime allowance until you actually take those pension benefits. When you are assessed, if you have previously taken other pensions, so say for example, you take your NHS pension, but you previously accessed a little personal pension or an ABC or something like that, then when you access that previous pension, what they will do is they will issue with what's called a lifetime allowance certificate, which states what percentage of the lifetime allowance you have remaining. So then when your pension that you are taking now is assessed, they will apply that against your remaining lifetime allowance. And if you go over that, then a tax charge does apply. But the key point to remember is that although for something like a personal pension or a stakeholder pension or an ABC that has a fund value, the value against the lifetime allowance is just simply that fund value. For a defined benefit pension like the NHS, all versions of the NHS pension scheme, the way to calculate what the lifetime allowance value is you take the pension income, you multiply that by 20, and then you add on any lump sum that might be payable. Because they've reduced their lifetime allowance multiple times, each time they've reduced it, they've had to offer what's called lifetime allowance protection. And fundamentally, what you need to understand is that this is a pretty complex area, that there are a whole variety of different protections that you may have applied for in the past, and some of them are still open now. Some of these forms of protection are very easy to break. And as such, even if you do think that you've got lifetime allowance protection in place, it's probably a good idea to find out and double check whether you have actually broken it. And it's also very important to remember that when it comes to a defined benefit pension like the NHS pension, the structure of how you take your pension and even when you take your pension can have a significant impact on its value when compared to the lifetime allowance. So there are potentially significant tax savings that can occur. However, fundamentally, for anybody listening, if you think that your pension benefits were worth more than about 1,080,000 on the 5th of April 2016, then you should probably consider applying for lifetime allowance protection based on the 2016 reduction. So what are the key points to remember about the lifetime allowance? Fundamentally is that it's the total value applied to all of your pensions. So if you've only got one pension, it's just that one, but if you've got more than one, it's the total value of all of them put together. A variety of factors affect it, and fundamentally, if you are in danger of exceeding it, then getting further advice, guidance, or information can be critical to minimizing the amount of tax that you need to pay. The 2016 protections can still be applied for, as already mentioned. Another key point to remember is that there are complex interactions between the annual allowance, the lifetime allowance, and income tax. And sometimes trying to work out which of the various different options are most beneficial to you can be extremely complicated. So number 3 on your to-do list would be get yourself a projection of your pension to your desired retirement age. If that's just the normal retirement age of the scheme, then you should be able to get that straight from total reward statements. Once you've got that projection, have a look at the income that it's telling you that you would be likely to get, multiply that by 20 and add on the tax-free cash, and just look, does that number exceed the lifetime allowance? If it does, then you may need to consider talking with someone and getting some, if you like, a little bit more guidance around that. And likewise, if it doesn't, then assuming that you don't have any other pensions, then you shouldn't really have a problem with the lifetime allowance. As also previously mentioned in other webinars, then a thing called pension freedom came to effect on the 6th of April 2015. From your perspective, 2 key points to remember about it are, firstly, it does not apply to NHS pensions or any other unfunded state sector schemes. So schemes such as the civil service, teachers pension scheme, armed forces scheme, etc. But it does apply to most other private sector company pension schemes, personal pensions, stakeholder pensions, so on and so forth. And because of the changes to state pension age and normal pension ages for the various different schemes, a lot of people that might have previously been sitting there thinking, okay, well, I was going to retire at 60, and maybe I was going to get my state pension from 60 if I was a lady. How do I plug that gap now between 60 and so of 66 or 67 when my state pension is going to kick in? And there can be some really great benefits from looking at pension freedoms if you've got old personal pensions, stakeholder pensions and things like that to help you plug that gap. So it's just important to bear that in mind. From the various seminars that we've been doing over the years, and also just from, if you like, feedback that we've had from individual members of staff and also people that do these calculations for you, we've received a variety of feedback. And fundamentally, one of the key points there to remember is the fact that although the annual allowance and the lifetime allowance are completely standard things, literally no 2 people's situation has been the same. You can't apply what was the case for one person to another person. Each individual person has to be worked out individually. And likewise, for some people, their individual circumstances can make understanding what is the best option extremely difficult. And also, although we get this one crop up in quite a lot of seminars, there's a lot of people turn around and say, oh, well, I've got it myself on a financial advisor, and I'm very happy with the advice that he gives me around ISAs and things like that. They've already told me, no, I can't give you advice on NHS pensions. There is definitely not that many advisors out there that will actually provide advice around NHS pensions. And the only other key point was that every single person that had gone to Total Wealth Planning and asked for advice around this has ended up significantly better off, both from an understanding of what their situation is perspective, but also financially. So again, in order to try and help illustrate a few scenarios, these are real life cases that have been dealt with by Total Wealth Planning. We've changed identities and things like that to protect people, but just to go through a few of them. First example was an NHS senior manager who'd been receiving annual allowance notification letters from NHS Pensions for some years. And because they'd heard through the grapevine that they'd actually opted out of the NHS pension scheme because they thought that was going to stop the annual allowance tax charges. So once they'd been through the advice, what conclusions did that advice provide them? The first one was that they had annual allowance breaches from 2 previous years, and also from the most recent year, even though they had opted out, and that none of them had been correctly declared. It was also very apparent that by opting out of the scheme, even though they were going to suffer annual allowance tax charges, it was actually making them approximately £12,000 a year worse off just simply because they weren't gaining the advantage of all the employer contributions and the increases into pension that they would have otherwise got. But likely it was also quite good to be able to reassure them that although they would likely have lifetime allowance issues at a later point in their career, remaining a member of the pension scheme was still going to be beneficial for them. Basically, all of the tax charges were not going to outweigh the benefits of remaining a member of the scheme. So in scenario 2, this was an NHS consultant who again had been opted out of the scheme some years previously and again had been receiving annual allowance notification letters in some years. And in this particular person's case, they assumed that although they were receiving these notification letters, they couldn't be right because they'd opted out of the scheme. So again, once they've been through, what conclusions did the advice provide? Basically, it turned around and told them that although that they had nominal or potential breaches in previous years, these were mopped up by the carry forward that they had available to them. But it also, when it was calculated, it showed that actually when they paid the annual allowance charge due for the most recent year, which wasn't going to be mopped up by carry forward, they needed to use scheme pays in order to do that. Likewise, like the previous scenario, they found that opting out of the scheme was actually making them significantly worse off. And likewise, when we went through the scenarios and looked at lifetime allowance and annual allowance altogether, we worked out that if they simply changed the structure of how they were going to take their benefits, that this would potentially save them anything up to £75,000 in lifetime allowance tax charges. So in previous webinars, my colleague Neil has talked a lot about planning. Fundamentally, the key point to remember about planning is that as human beings, we do have a very strong tendency to think short term. We tend to think about today, we tend to think about tomorrow, maybe next week, next month, some of us next year, but how many of us do genuinely think about 3 years' time, 5 years' time, 10 years' time, 20 years' time? When you are looking at planning, and particularly retirement planning, you need to make sure that you're taking that long-term view as well as the short-term view. You need to make sure that you understand how taxation affects you. You need to make sure that you understand the risks. But one of the key points to remember is that you need to understand what your fallback position is. If something goes wrong, where is that going to leave you? Is that acceptable? Do you need to put something into place to mitigate that risk or change that fallback position? And the only other point to remember is always be adaptable. I always talk about two certainties in life being death and taxes, but there is one other certainty, and that is change. Everything always changes. So make sure that you're adaptable and that you can adapt to those changes. So just a quick reminder of the to-dos to take away from today. Firstly, make sure you get that projection and have a look. Does this mean that you're likely to exceed the lifetime allowance? Secondly, pull out your most recent P60 and make sure that you understand what your taxable income is, and then add on any other taxable income that you have. And if that's more than 110,000, make sure that you request that pension savings statement from NHS Pensions. And likewise, if you ever have or ever do receive a letter from NHS Pensions talking about the annual allowance and that you might have exceeded, make sure that you get some expert help and guidance to understand, have you actually exceeded it? And if you have, what do you need to do? Obviously, within this webinar, we can't cover off everything and we can't go into too much depth, but if you do want to ask any further questions after today, then do please feel free to email us. Just email info@eulogie.co.uk, give us your name, a telephone number, a brief indication of what it is that you want to discuss, but please also do code C4 on there, because that way we can identify where the query has come from. Likewise, if you are looking at getting further advice, please do make sure that if you are getting financial advice, make sure that you're speaking to an appropriately qualified and regulated financial advisor stroke planner who is regulated and authorised by the Financial Conduct Authority. Likewise, make sure that if you're getting any advice around estate planning, wills, things like that, that it's either an appropriately qualified and regulated estate planner or an appropriately qualified and experienced solicitor. Lastly, just to confirm that we do take GDPR very, very seriously, but we do offer if you like, a newsletter, and we do send out information to people that want to receive it. That service is completely free of charge. You can opt out of it at any point in time, and none of your information or none of your contact details are passed outside of our group of companies. We do not, if you like, pass that information on to anybody else. So that is our contact details, depending on what, if you like, which option that you want to use. So thank you very much for your attention. Like previously mentioned, if you do have any further queries, please do feel free to email us. And at this point, I will hand you back to Carla. Thank you.
Thank you so much, Duncan. Really informative, and I'm sure our audience today will take those tips away. I guess for the audience, we will send the slides through and we will send the recording through. And as Duncan has suggested, please email him at info@eulogie.co.uk if you would like more support. Can I take David? Is there any questions in the chat room that you'd like to Duncan?
Yes, thank you, colleagues, for sending your questions. I've themed those that have a similar feel, and there are one or two that are quite specific, Duncan. But no, so I'll go crack on. So the first one: as an approximate percentage, how much can I safely withdraw from my retirement fund per year without worrying about running out of money?
Now that's a very good question. And the simple answer to that question is it entirely depends on your personal circumstances. Obviously, clearly NHS Pensions is a specific defined benefit pension, so you get a certain amount of pension each year, and that is fixed, and once it's in payment, that continues. But I'm assuming that you're talking about things like personal pensions, stakeholder pensions, and so on and so forth. There is no hard and fast answer to that, because it will depend on so many things. It will depend on what it is that you're trying to achieve. It will depend on what risks you're prepared to take and happy to accept, what things that need to be taken account of. Do you have enough other forms of guaranteed income? It's very much, that one is unfortunately very much of a how long's a piece of string question. So I can only apologize for that. I can't give you a specific answer, because it will be entirely dependent on your personal circumstances.
Thank you. This is quite a specific one. I'm 34 and earned more than £200,000 last year, so now have a £10,000 pension limit. How do I save for retirement?
Well, assuming that you're carrying on being a member of the NHS pension, or assuming that you are a member of the NHS pension, fundamentally you need to assess, is remaining a member of the NHS pension a good idea? For most people, even those that are going to suffer tax charges, generally speaking, it is. Just simply because you have, although it's costing you a certain amount of money, the NHS is also making up a very large chunk of those benefits. So at the end of the day, it boils down to crunching the numbers and working out, okay, what is the net cost to you as an individual? What do you lose by being a member, and any other tax charges that apply? And what is the net benefit to you that you will get when you retire? And unfortunately, that is a very complicated calculation. And again, I hate to say it, but it has to be done on an individual basis. But usually for most people, it tends to be beneficial to remain a member.
Thank you. This, I think, more of a statement than a question, but I'll invite your thoughts, Duncan, anyway. I had a very stressful time with HMRC, as they were unaware of how the scheme pays, and it took over a tax year to resolve, meaning I had to get a loan. I understand there is a specific team that colleagues should refer to when dealing with HMRC. Could you address this if possible?
From an individual perspective, we don't tend to get involved into the conversations with HMRC. In part of my other role, I actually do lots of these calculations and work things out for people, but it is usually at that point where we would then liaise with that particular person's accountant and then the accountant will usually liaise with HMRC. So it's probably a much better question for an accountant rather than ourselves. We're very good at working everything out and working out what the net cost and benefit is, but accountants tend to be much more au fait with the workings of HMRC. The only thing that we do know for certain is that when you talk to HMRC, they do tend to seem to try and be helpful. They do seem to have this reputation as being a little bit difficult, but certainly from the limited experience that we have of dealing with them, they tend to be fairly understanding about this particular area because they understand that it is very, very complicated, and it's very difficult for people that are not pension, money or math experts to wrap their heads around it. So consequently, they are aware that issues do tend to occur sometimes.
Thank you. What are your views on taking my tax-free cash when I reach pensionable age?
Again, that's another very much about how long's a piece of string question. In order to work out the answers to that question, firstly, you would need to speak to an advisor because it would be individual advice. And I am not an advisor. I do train them on these subjects, but I am not an advisor, so I can't answer the question specifically. But from a generalistic perspective, first off, you need to understand what it is that you're trying to achieve. What are the goals that you have? Not just the goal of whether you want to take tax-free cash when you reach the normal retirement age of the scheme, but what it is that you want to achieve at that point, 5 years later, 10 years later, 20 years later. So it's about mapping out what does your retirement look like is much more of a sort of an answer to the question. And once you've mapped that out, then they can work out what is the best option for doing that. The only point I would make there is that when it comes to NHS pensions, if you are taking the tax-free cash, you are by definition taking the whole thing. You can't part take. The only way you can split up taking your NHS pension benefits is if, say, for example, you are taking the 1995 scheme benefits, but you're leaving the 2015 scheme benefits. You can't take part of the 95 scheme. You have to, it's all or nothing, unfortunately. So that's hopefully that provides some clarity on that.
Thank you. If I do not wish to take an income from my pension and would prefer to leave it to my loved ones, what do I need to do? I am close to my retirement age and do not need an income.
Okay, with NHS pensions, unfortunately, the only people that you can leave it to are spouses and civil partners, and or if you like, potentially there's a dependents pension that can be paid out to dependent children. There is no fund value per se, so it's a question of you either take it or you don't take it. And unfortunately, as I mentioned, it's not subject to pension freedom, so there is no way you can move it from that environment into, if you like, the pension freedom environment where it becomes a pot. The government's never specifically stated why they don't allow pension freedoms to apply to unfunded state sector schemes, but a quick little bit of just sort of looking at the numbers, the liabilities that sit within those schemes run into multiple trillions of pounds. So if the government suddenly had to start coming up with lumps of money to move out, it would, well, basically it would bankrupt the country because they're anticipating paying it out over a very long period of time rather than in a big rush. So I would guess that's why they don't allow it.
Thank you. How much can I build up in my pension pot before incurring extra tax? I currently earn £105,000 and I'm 52 years old.
That is where you need to do if you like, one of the to-dos, have a look at the projection, get yourself that projection, have a look at it. What is that likely to be at that point you want to retire? Multiply that income by 20 and then add on any tax-free cash if there's a default tax-free cash like there is within the 1995 scheme, and that will give you a number. Now, if that number is 900,000 and you're currently 5 years away from, if you like, normal retirement, then You can afford to build up some additional outside of the NHS pension if you want to, but you also need to be aware that if you get a pay rise, then your NHS pension benefits start stepping up. So, excuse me. So generally speaking, it's beforehand, it's a very difficult question to answer for a defined benefit scheme. The only thing that we can say is the threshold is about 47,000 per annum in pension income plus a default tax-free cash lump sum of 3 times before you start to run into the risk of going over the current lifetime allowance. For things like personal pensions, stakeholders, ABCs and things like that, it's very easy. It's just whatever the fund value is. So if the fund value is £800,000, you can accumulate currently another 273,000 or thereabouts. And that can come about either because you paid more into it or because the fund values grow and so on and so forth.
Thank you. And the final question. I have heard that the government might abolish tax-free cash. What are your thoughts on this?
It's a rumour that's been mooted about for absolutely at least the last 5 years. I don't know is the short answer to the question. I think a lot of it will depend on political will. Given the current situation and the amount of money the government is spending, clearly the government are going to look at ways of potentially either generating more in tax revenue or reducing government expenditure. Will pension tax-free cash be part of that? In truth, I think it's probably unlikely, just simply because I think they would have an awful lot of very angry voters at that point. And I think any government that did introduce that would probably not remain in government for very long. But I never say never on those kind of things. It's they've caught us out on various different occasions where they've moved the goalpost. But fundamentally, the idea of a pension is they want to encourage you to save to support yourself in retirement. And the more unattractive they make that, the more likely thing you are to then fall back on other forms of support from the government, which they clearly would rather not have to pay out. So I don't really know.
Thank you, Duncan. That takes us to the end of the questions. Thank you.
Okay. Yeah.
Thank you, David. I think there were some really interesting questions there, and thanks, Duncan, for really well. I guess that brings us to the end of our webinar today, which is the 4th webinar of 6. So please do make contact with us at agem.od@nhs.net if you'd like copies of previous webinars on pensions, retirement planning, pensions, etc. Estate planning. Thank you from our team today. So thank you, David, thank you, Duncan, and thank you, Eulogie. And all stay safe and hopefully see you at next Wednesday's lunch and webinar. Thank you very much.
Thank you all. Thank you, Duncan.